How should investors play the November jobs report? Joining us now, David Kelly, JP Morgan Fund's Chief Global Strategist. David, good morning.
Good morning.
So let's talk about ranges here. Like, if we're in the 50 to 100 range, or for 100 to 150, and then 150 to 200, are there three different outcomes from that, or different takeaways from that?
Well, I think the first two won't make much difference.
50 to 100, 100 to 150.
Yeah, if you get a very strong report, then I think it does make a difference, because it says that the economy is so strong that it can actually withstand the distortion from Hurricane Sandy, withstand also, I think, some of the hesitancy to hire ahead of the fiscal cliff. And if the economy is doing that well with all the uncertainty coming out of Washington right now, imagine how well it can do when some of that uncertainty is resolved. So if we get a very strong number, I think that if we get a very strong number, it will cause markets to react. But we're looking for something a little weaker than that.
Let's just underline that first point. What you're saying is the market has really discounted essentially Sandy effects from this number, and it's not going to read overall economic weakness from a weak economic number.
That's right. I think the market's going to have a very hard time actually focusing on this number, because you have these two distortions, both Sandy and also potentially a delay in hiring because of the fiscal cliff. But we know that they are both hard to read, and they're also both temporary. And so, if you're going to go cliff diving in about 4 weeks, it's a little hard to focus on these two issues right now.
Well, but that would stand to also affect the upside too, right? If I see 150 to 200, I would know the economy is more resilient, but I also know the economy could go over a cliff in 4 weeks.
Well, yes, but to the question of how should investors play this, the key thing I think to recognize is we don't know exactly what this jobs report is going to tell us about momentum because of these distortions. But we do know that once they solve the fiscal cliff, if we assume that they do come to an agreement, even in early January, you know that the uncertainty tax is going to go down. The uncertainty on the markets and on the economy is going to go down. And when uncertainty goes down, that should push both stock prices and interest rates higher. So I wouldn't try and play this number. I'd try and position myself to take advantage of a bounce in both the market and interest rates when we get this fiscal cliff issue resolved.
David, give me a sense. Give me a number. What happens on the day that Becky goes on TV and says, breaking news, a deal has been reached between Boehner and the president? Well, how much does the Dow go up?
Well, I'm not going to give you that. I'll give you.
Come on.
Obviously, I think it should be worth hundreds of Dow points if and when that happens. But of course,
That'll be Becky, though, right?
We'll see hints that this is coming, and then we'll probably get the news, and the market will bounce, and then the day after, people may sell the news. But the basic point is this, though: there should be an urgency among investors right now if they look at the relative valuations, because we still have this has been a sort of a tale of two tales here. We've got these tail risks and tail valuations, and the problem is if you get past the fiscal cliff, one big tail risk is eliminated, and that should push both interest rates and stock prices higher. And they are, the valuations are very extreme. Long-term rates are just way too low, given an economy.
It doesn't matter what the deal looks like; it still goes up a couple hundred points.
I think that's right. So long as the deal, I think what we're going to get is a two-stage deal where you get a down payment in 2013, which brings the deficit to GDP ratio down from say 7% down to about 6%. If we can do that, along with some long-term agreement about we're going to get another $1 trillion out of entitlements, or $1 trillion from taxes, and a $1 trillion from somewhere else, but some range of what we're going to do in 2013 to try and where we're going to get the money for the rest of the sort of fiscal issues over the next few years. But some down payment. If we get that down payment and it's a reasonable down payment, not one that's going to crush the economy, then I think the market could react very well to that.
David, what's your opinion of what's going on in the economy ex-Sandy? You were saying a better jobs number would show the economy is resilient. Do you think the economy is resilient? Is it doing, if you can take out the effects of the hurricane, better than people think?
I think it's got so much potential. I mean, I see all this hesitancy here, but pent-up demand is forcing the housing market higher. Pent-up demand is forcing the vehicle market higher. Consumer finances are very much improved. People have locked in these 30-year fixed-rate mortgages at wonderful rates. So I think everything is actually pretty primed here. It's just this cloud of uncertainty. So when that uncertainty breaks, I think the economy could do much better in 2013. We're not seeing it right now. This economy has not taken off right now. I think it's still sort of a 2% economy right now. But it certainly has the potential to do much more than that if we can just reduce the amount of uncertainty coming out of Washington.
I made one of my 2013 predictions that we'd have at least 1/4 of 3% growth, maybe another one. What do you think, David?
No, absolutely. I think that's quite. We're so conditioned to this 2% world that to get the unemployment rate down, you're actually going to need to put in some 4% somewhere along the line. I think we can certainly get a 3% quarter, and I'll raise it. I think we may get a 4% quarter. So I don't think we'll get 4% for the year, but I think we could get a 4% quarter in 2013.
I'll say 5. All right, David.
All
thanks
right,
very
if we're
much.
speculating. All right.
David Kelly from JP.